Bismillah Rahman Rahim. Assalamu alaikum and a very good morning from London. Welcome to Module 2, which is part of Cambridge Islamic Finance Structuring Master Series. This module is on WAD and its applications in modern banking and finance. Cambridge Islamic Finance Structuring Master Series is designed and delivered by myself. My name is Humayun Dar, and I'm currently serving as Director General of Cambridge Institute of Islamic Finance. WAD module, which is module number 2, we call it IFAP 2 as well. It is part of a 10 module series called Cambridge Islamic Finance Structuring Master Series. We have already delivered module 1, which was on the art of structuring Islamic financial products. Today, we shall be focusing on WAD and its applications in modern banking and finance. After this, there are 7 modules to be delivered in 2023. The next one would be on structuring Islamic investment products. Module 4 would be on innovations in sukuk structures. Module 5 would be on the uses of mutuality and cooperation in Islamic finance. Module 6 would be on the uses of law of large numbers and financial inclusion structures. Module 7 would focus on the use of technology for innovation with a focus on Islamic fintech. And Module 8 would be on structuring Islamic social finance products. Module 9 would be on developing profitable non-bank financial products and institutions. Before we end this season 3 of Cambridge Islamic Finance Structuring Master with Module 10, which is entitled Advanced Topics in Innovation and Structuring of Islamic Financial Products. And this IFAP 10, Module 10, would be an extension of our first module, The Art of Structuring Islamic Financial Products. Like any module, we have 3 learning objectives of this module number 2. The first objective is to introduce you to WAD and its applications in modern banking and finance, with a particular reference to Islamic banking and finance. And this is suggested by the title of the module as well. It is also our intention to introduce you to Sharia Standard number 49, issued by Accounting and Auditing Organization for Islamic Financial Institutions. And this Sharia standard focuses on WAD and its various applications in Islamic banking and finance. Learning objective number 3 is to incite you to challenge traditionally held Sharia rationale for permissibility or otherwise of certain practices. And this is a learning objective which we have carried forward from the module 1. Those of you who attended module 1, you would have noticed this thing. There are 3 corresponding learning outcomes after this module. And for those keen participants who would like to read some material around it, you should be able to apply the concept of WAD in structuring of Islamic financial products. You must also be able to understand Sharia rationale to critically evaluate and assess Islamic financial products from a Sharia viewpoint. And this learning outcome is actually the same as we used for module 1. Learning outcome number 3 is for the participants to understand some advanced aspects of WAD not covered by traditional fiqh books or juristic books. Those who attended module 1, you would have noticed that this was a very light module, and this was intended. Module 1 is an introductory module, and this could be considered as something like paracetamol. However, you would notice that our today's module is actually quite heavy in a number of aspects, especially when it comes to structuring of some advanced level Islamic financial products. So module 2, WAD and its applications in modern banking and finance, could be considered as a heavy dose of antibiotics. on previous occasions, we have got some feedback that some people might find that this is too theoretical in its contents, although we claim that this is not theoretical at all. It is based on a number of examples which have huge practical relevance, especially for those who are interested in structuring of Islamic financial products with an emphasis on innovation. After this introduction to IFSM and the module title, I would like to go into the main body of the module, which is WAD and its applications in modern banking and finance. We must understand WAD. WAD is something which is not visible to quite a number of observers of Islamic banking and finance, although its applications are everywhere. WAD is used in Islamic retail banking products. It's used in Islamic capital market products. And of course, this is used in quite a number of other exotic structures being used in Islamic banking and finance. The students, observers, and academicians, they are familiar with the other agreements and contracts like murabaha, mudaraba, musharaka, ijara. However, we find that there is not a kind of explicit emphasis on WAD in the books written on Islamic banking and finance. So WAD is an Arabic word which simply means a promise. It is merely an undertaking and it doesn't amount to a full contract. In any legal system, a contract is the building block of any relationship. Whether this is in the context of Islamic finance, whether this is mudaraba, musharaka, murabaha, all these are examples of full contracts. WAD, on the other hand side, is not a full contract. It is just one leg of a contract. Some people say that this could be considered as only an offer. However, this is not the exact kind of view on WAD. Yes, it is an offer. However, this is more than an offer. And we will see how this is the case. And this is definitely less than a contract. WAD in itself is not a contract. This may lead to some contracts and their executions in future. So it is merely a promise. And in English, we may say that this is an undertaking to do something by someone. I must also differentiate between another word which looks very similar to WAD. However, it is very different from WAD. There is a word in Arabic which is called ahad. That means a covenant. And ahad is actually a contract. And as I said, WAD is not a contract. As a baseline concept, WAD is unbinding on the promisor and hence cannot be enforced by promisee. What I mean by that one, as a baseline concept, means in classical Islamic fiqh, WAD has never been considered as a contract. And because this is not a contract, it is not binding on someone who promises to do something. And I must explain also that, when we say that this is a promise in Islamic law is not binding, it doesn't mean that Islam promotes unethical behavior. In general, we say that if someone has promised to do something, then the promise must be fulfilled. Yes, on ethical grounds, this is absolutely right that if someone promises to do something, this is a requirement. This is an ethical requirement that the promise should be fulfilled. However, legally, this may not be true. So if I have promised to do something for you, for example, if I say that I promise to let you to borrow a book from me next week, and next week when you approach me, I say that, I'm not going to lend you this book. You have every every right to have a negative view on me, but you cannot take me to a court to enforce that promise on me. And there would be no legal liability on me. Yes, you can have an ethical view on my behavior, but otherwise, legally, I should not be held responsible for promising something and not delivering on it. In modern Islamic banking and finance, however, given widespread application of WAD, it can be enforced by the promisee, i.e., the party which has been given the promise. And hence, once a promise is called upon by the promisee, it can be considered binding in certain circumstances, and we would go through those circumstances in this module. So just to summarize, WAD in classical juristic terms is an unbinding arrangement, which is now being used in Islamic banking and finance in such a way that certain conditions are put on WAD for it to become binding. Let us look at WAD as a non-binding undertaking. As a non-binding undertaking, WAD has no value in commercial transactions, and hence it has only limited relevance to banking and finance. This is with reference to the classical view on promises, because classical fiqh would say that a WAD is non-binding. If it is non-binding, then it shouldn't have any value. So if I promise to do something and you call upon it and I don't deliver on my promise, then that promise doesn't have any commercial value. It has a value only if the promisee calls upon it and the promisor accepts it, and the two parties then enter into an agreement accordingly. So it has a potential value. So if I have promised to do something for you and you call upon this promise and I honor my promise, then this promise has a value. I would like to call this a potential value. A plain vanilla classical WAD or promise would not have any commercial value. As per the modern juristic opinions, i.e. the Sharia standard number 49 issued by Accounting and Auditing Organization for Islamic Financial Institution, there are certain conditions that must be met for a WAD to become binding. And I would recommend all of you to download this Sharia standard number 49. This is available on the website of AOFE. You go there and download it and go through it. This is not a very lengthy document. It's about between 20 to 30 pages. And these pages, they're written in such a way that it's not a very lengthy kind of reading. My strong recommendation for you would be to download this Sharia standard number 49, go through it if you want to have a good understanding of WAD and its applications in Islamic banking and finance. Now, according to this standard number 49, a promise becomes binding when the promisor causes the promisee to incur a liability as a result of the promise. We will go through some examples. So if I have promised to buy your car, so you have a car and I go to you and I say, I promise to buy this car from you on May the 30th for a price which we agree between us. And after you have taken that promise from me, or after I have given this promise that I promise to buy your car so and so for this price on a future date, you go out and you actually buy another car because you assume that on May the 30th, I would buy this car. So the promisee in this case has incurred a liability. It has bought another car, and keeping in mind that the price you will be getting from me from the purchase of your car to me, you will be using that price as a partial price for the other car you have bought. So because of this liability which you have created following receiving a promise from me, a court of law may make this wad binding on me, i.e., I would be required to honor this promise because you have incurred a liability. So a promise becomes binding when the promisor causes the promisee to incur a liability as a result of the promise. This is clause 3.4 of Sharia standard number 49. Now, the second condition mentioned in Sharia standard number 49 is that a promise conditional upon a performance becomes binding when the promisee has performed as such. So, for example, if I say I promise to buy 1,000 Apple stocks from you, if you have actually bought these stocks from the market from someone, so you have then performed in accordance with this promissory arrangement. And if on the future date I don't buy these stocks from you, then you can force me to honor the promise, i.e., in that case, a conditional promise would become binding as well. What is the definition of wad? The definition you see on the screen, this is extracted from the Sharia standard number 49 issued by Accounting and Auditing Organization for Islamic Financial Institution. When you go through the standard, you might find that this is, in terms of words, this is not exactly the same as the one used in the standard. However, it is actually exactly the same. These are my own words to make the definition more understandable. So a promise is deemed to have been given by a party A when the party A informs another party B of its resolute intention, undertaking, to act in future in the interest of the party B that may have an option to avail itself of the act to be undertaken. This is, in very simple terms, it is an undertaking to do something in future and informing another party that this is something I am going to do. And if they are interested in this arrangement, they would have an option. Now, wad is actually a basic building block of Islamic theory of options. Quite a few other contracts have been presented as option-like contracts. Salam has some kind of optionality in it, and Arbun has got some optionality in it as well. However, if someone would like to develop a comprehensive theory of Islamic options, then WAD is the best candidate to start from. So this definition I would read again. A promise is deemed to have been given by a party A when the party A informs another party B of its resolute intention to act in future in the interest of party B that may have an option to avail itself of the act to be undertaken. So party A in this arrangement shall be called promise giver or promisor, and party B shall be called promisee, or the party which has been given the promise, and the action to be taken will be called promised action. A promise by its very definition is unilateral, and this is very, very important, and because this distinguishes wad or promise from a contract or aqd. So a promise by its very definition is unilateral and must therefore be differentiated from a contract that must always be at least bilateral. Contracts can be multilateral as well, where more than two parties are involved, but wad or promise always is unilateral. What do we mean by unilateral? So basically, if I have written a promise on a piece of paper, this unilateral requirement means that here, after I have written my promissory statement, it should bear only my signatures. It should not have the signatures of the promisee. If both promisor and promisee, they sign on a promise, then it ceases to remain a promise, that becomes a contract. So a unilateral arrangement would be only by one party. So if I promise to do something, this is my undertaking, and this should be executed with only my signatures. Promisee should not be signing on that document. Let's see some examples of WAD. Simple examples of WAD. A party A promises to lend $100 to party B on 31st of December for a period of 1 year. So if today is, today is 27th, 27th of April, if I promise to lend you $100 at the end of the year, this is one example of WAD. Now, if we take the classical view on this promise given by me, then it is not binding. On the 31st of December, you come to me and say, oh, lend me $100. And I say, sorry, I do not want to lend you $100. This is not binding on me. So this is the classical view. For this to become binding, you must have incurred a liability, and you must be able to demonstrate that you have actually made some arrangements after taking that promise from me. So second example, a broker promises to lend 1,000 Apple shares to a client for 30 days, starting from a specific date in future. So example number one, it's about lending money. And example two is about lending another financial paper, a stock or share. This is possible as well, to promise to lend some money, to lend some other financial instruments as well, as long as these instruments in themselves, they are Sharia compliant. So if Apple stock happens to be Sharia compliant, then I can promise to lend or I can promise to sell in future. So this is example number two. By the way, I think last time when we checked, Apple stock was a Sharia compliant stock. I haven't checked it lately, but I think it still remains a Sharia compliant stock. Quite a number of other tech-related stocks, they remain Sharia compliant. Netflix is one exception because this falls in the entertainment industry, which is not considered a Sharia compliant sector. The third example of WAD is an SPV promises to sell an asset X to a company for a specific price on a future date. And we would look into this example later on in this session. Example number four, a retailer promises to give 50% discount to its customers once they have made 100 purchases transactions. Now, this is an example of a promise conditional upon something. So a promise which is associated with a condition, or this could be considered as an example of a promise which requires a performance. So if the customer has performed, i.e., if the customer has made 100 purchases, then it would be binding on the retailer to give 50% discount. Emirates Airlines promises to give 100% more Skywards miles to all the passengers who have attained gold status. So all these are examples of permissible WAD or permissible promises, as long as the action to be taken is Sharia compliant and the asset on which the action is to be taken is Sharia compliant as well. So money is Sharia compliant. Some people, they have a view that a money which has been created through an interest rate mechanism, this money multiplier, all that kind of things, fractional reserve requirement system. They may say that the money which we use, this is not Sharia compliant. I don't take this view, and majority of us, we don't take this view that this money is haram. If this is haram, then all of us, we should be taking out that money from our pockets and throw it away. But that's not the case. So money is Sharia compliant. Apple stocks, if they fulfill the Sharia screening requirements, then they are Sharia compliant. This asset X, if it is Sharia compliant, only then a promise can be given and taken on this one. A retailer promising to give discount to customers once they have made 100 purchases, Sharia compliant purchases. And of course, Emirates Airlines giving 100% more Skywards miles to the passengers attaining gold status. This is a Sharia compliant arrangement as well. So let's look into example number one first. This is January the 1st, 2021, for example, or it could be April the 27th. So one hypothetical date. So this is today. If we say this is today, the bank promises to lend $100 to a customer on December the 31st for a period of 365 days. So on this date, this promise is given by the bank. Now, this promise can be given in the form of a letter. So I receive a letter from my bank, a Rayan bank, for example, or any other bank I deal with. And the bank says that we are promising, we undertake to lend you $100 at the end of the year if you require this much money, and this will be interest-free loan given to you. When December the 31st comes, the customer, me, I call upon the bank to lend me $100. This is an example of a bank. Banks are very tightly regulated institutions. So if a bank has sent me a letter, and in that letter it says that we are promising to lend you $100, those of you who work for banks, you would know that the regulator would take this statement very seriously. So although from Sharia viewpoint, this wad would be unbinding, but the regulatory requirement for the bank would be to honor that promise. Hence, this would become a binding promise given by the bank. So on December the 31st, when I go to my bank and I say, well, this is the letter you issued on January the 1st. Lend me $100 interest-free. The bank will have to honor this promise. Now, the difference between a contract and a wad is what? If this was a contract, then on December the 31st, whether I have called upon the bank or not, the bank would be transferring $100 into my account as an interest-free loan. Because this is a wad, the bank would act upon my advice or my instruction on December the 31st. If I don't go to the bank, and if I don't call upon the promise given by the bank, then the bank is not obliged to automatically put that much money into my account. So this is the difference between wad and a contract. The second example, a broker promises to lend 1,000 Apple shares to a client for 30 days, starting from a specific date in future. For example, the broker says that on June the 30th or from June the 30th, if you come to me and call upon the promise given by me, I would lend you 1,000 Apple shares for a period of 1 month, 30 days. This promise is given by the broker on January the 1st. So broker promises to lend 1,000 Apple stocks to the client on a future date. If that future date is June the 30th, the market conditions are such that the customer is interested in having access to 1,000 Apple stocks. So the customer would call upon the broker to lend him 1,000 Apple stocks. In general, security lending in the conventional framework has some kind of premium or interest-based arrangement. That is not acceptable. So we are not referring to the cost of lending or cost of borrowing. We say that this is an interest-free arrangement whereby the broker promises to lend 1,000 Apple stocks to a customer for a period of 30 days. So once the client has called upon the promise, then the broker would be putting 1,000 Apple stocks in the account of the client on that date. If this was a promise starting from a specific future date, if the client doesn't want to borrow 1,000 Apple stocks on June the 30th, rather they find July the 30th when it comes, this is more appropriate. They may call upon the promise or any other date after June the 30th. So it is not automatic after a promise has been exchanged that the lending and borrowing would take place. No, an action has to be taken by the promisee to go to the next level or next stage. Now, this is an interesting example of a WAD. An SPV, special purpose vehicle, promises to sell an asset X to a company for a specific price on a future date. Now, let us look at this one. So we have this SPV. This is a company, special purpose vehicle. There is another company. At T naught, SPV promises to sell X to company on TN, a future date. Now, this is an interesting thing. In case of a contract, it is an absolute requirement that at the time of entering into an Islamic contract, the object of, for example, if this is a sale contract, object of sale and the price, they must be known unambiguously. In case of WAD, this is not a requirement. So here we are saying SPV promises to sell X. So there is a definite asset there to company on a future date TN for a price to be agreed. So price may not be known when you are giving and taking a promise. Price may not be known definitely. There might be a formula, there might be some kind of indication or a price to be agreed in future. So this is a promise given by SPV to company at T naught now. Step number 2, at TN on the future date, company calls upon SPV to sell X for a price P. This is the price which is to be agreed between the two parties. And if SPV honors this promise, then what would happen? 3A, SPV delivers X to company. There would be a contract signed at that time. So SPV, pursuant to that sale and purchase agreement, would deliver the asset X to company, and company would be then paying the price P to SPV. So at T naught, a promissory arrangement has taken place, which may lead to a sale and purchase agreement at T naught if the company promisee calls upon this promise. Now, if at T naught, SPV has promised to sell X to company on TN for a price to be agreed. However, when TN comes, the company doesn't call upon this promise. Then 3A and 3B, they wouldn't take place. So this is actually an option of this company whether to call upon the promise or not. This must explain the difference between WAD and a sale and purchase agreement, which becomes binding once it has been executed. Now, this is the arrangement which I have explained, and I would like to put this arrangement in a context as my first example of contemporary application of WAD in banking and finance. This SPV, if we go back in the time, this the promissory arrangement starts at T naught. So at T naught, SPV promises to sell X to company on a future date TN for a price. Before that, company sells X to SPV for a price P naught. So before that promise has been given, the company has actually sold this asset X to the SPV for a price. After this, SPV has leased back X to company for a specific rental to be paid frequently. So the first step was the company selling this asset X to SPV. Second step was the SPV then leasing this asset back to the company B. So this has already happened. Once this has happened, then the SPV issues sukuk, which are sold to investors. These investors pay the money to SPV, sukuk proceeds. These proceeds then go to company. So this is basically, as you know, a sukuk structure. In this example, this is sukuk al-ijara. So in this sukuk al-ijara arrangement, this promissory arrangement is very crucial. If this promissory arrangement is not there, the whole sukuk structure would collapse. So this is importance of the promissory arrangement in the contemporary Islamic financial transactions. And this is not only one example. You go to Murabha, for example, Murabha lil Amr Bishara, which is used in retail banking, for auto financing, for in some countries, this is used for Islamic mortgages as well. If the promissory arrangement is not there, these Islamic financial products would not work to the satisfaction of the bank. And of course, if the bank is not happy, these products would not be offered to the clients. So this is basically, this whole is uh, uh, the complete structure of a sukuk, part of which is this wad-based arrangement, which is absolutely essential for this sukuk structure to work. Now, if we take away, this is the whole structure. If we take away the other steps I explained, and if we go back to this promissory arrangement on its own, this is an example of a standalone wad. And when we look at this one in the context of sukuk, that is an example of an ancillary wad, which is defined in the Sharia Standard number 49, issued by Accounting and Auditing Organization for Islamic Financial Institutions. An ancillary wad is the one without which an Islamic financial product would not work. So this is essential for this sukuk structure to work. If this wad is there, if we take out this wad, the whole structure would collapse. In some cases, we call it an embedded wad as well. So this is the standalone. When we embed it with this sukuk structure, this is an example of ancillary wad or embedded wad. And Sharia Standard number 49 of Accounting and Auditing Organization for Islamic Financial Institutions says that if this is the case, then this wad would be binding, because if it's not binding, the whole structure would collapse. Sharia Standard number 49 is very explicit. It says that ancillary wads, they are required, they are permissible, and they can be used. But the question, is it Sharia compliant to take standalone wad? Okay, and I think this is a very important question, and we would be dealing with this one in this module. The AOFI Sharia Standard number 49 favors ancillary wads by making them binding. It is permissible to take standalone wads, and of course, these wads should then fulfill certain conditions, certain requirements. A standalone wad is binding only if the promisee has reacted to it by way of creating a liability. This is something I am making this as an explicit requirement. This is there implicit in a lot of structures, a lot of texts, but I'm making it as a kind of explicit statement. A standalone wad is binding only if the promisee has reacted to it by way of creating a liability. Thus, according to AOFE, if party B has reacted to the promise to purchase, PTP, given by party A and has actually bought the Apple stock. Remember, we used this example of 1,000 Apple shares. If party B has reacted to the promise to purchase given by party A and has actually bought the Apple stock, only then the PTP will be binding. This is a conservative view, although we can use some examples where the promise would still be binding if this hasn't happened, i.e., the promisee hasn't created a liability as a result of the promise. So two things I would like to emphasize. A standalone wad is binding only if the promisee has reacted to it by way of creating a liability. And an explanation of this, if party B has reacted to the PTP, promise to purchase, given by party A, and it has bought the Apple stocks in the example which we have given, only then PTP will be binding. A promise will be deemed funded. Now, this is the terminology I am introducing for the ease of understanding. So a promise will be deemed funded if the promisee has reacted to it by way of creating a liability. So if I have promised to purchase Apple stocks from you and you have actually bought the Apple stocks from the market, that would be an example of you funding the promise. So that would be deemed as a funded promise. A funded promise must then be binding on the promisor once the promisee calls upon it. Therefore, party B must fund the PTP before calling upon it. So could there be a valid economic reason for giving, receiving the promise to purchase? This question is important because when we talk about conventional options are in a way undertakings. However, those undertakings have a price. So when I want to buy a put option from a company through a broker, then I have to pay a premium. In this case, we haven't referred to any price to be paid, for any money to be paid to the promise giver. So the question we can ask, can there be a valid economic reason for giving, receiving the PTP if that premium kind of arrangement is not there? There could be a number of economic reasons for giving and taking promises. A fund manager may want to lock future prices of stocks, assets that they may wish to include in the portfolio in future. So those of you who are into asset management, into fund management, if you want to manage your portfolio properly, efficiently, effectively, then you would like to reduce uncertainties around the prices of the stocks, prices of the equities you want to hold in your portfolio. So if, as a fund manager, I have actually selected about 30 stocks on my watch list. Based on my investment strategy, I'm interested in these 30 stocks. And in future, depending on the market conditions, I would be picking up stocks from this sample out of this large universe. And if I am a prudent fund manager, I'm a risk-averse fund manager, given this possibility of me buying a stock in future, I would like to lock the future price of those stocks or assets I am interested in. If that is the case, there is a valid economic reason for me to enter into a promissory arrangement if it fulfills my risk management requirements. A funded promise must then be binding on the promisor once the promisee calls upon it. This could be deemed as a legitimate tool for risk management. So in this case, when as a fund manager, I have promised to purchase, when I say I want to lock the future price of stock. So if I have promised to purchase stock X from a broker for this price on a future date, and the broker demonstrates that pursuant to this promise given by me, the broker has bought those stocks, i.e., the broker has funded the promise, then this will be binding on me to buy that stock. This is part of the risk management regime. Another fund manager. So this was an example where a fund manager has a watch list and would like to buy a stock from the market in future. The reverse could be possible as well. A fund manager may be interested in locking the price of a stock that it holds now in their portfolio, and they would like to manage the risk of holding that stock as well. In that case, if they receive a promise to purchase from someone, so that would be another valid economic reason as well. However, in this second example, when party B has given me promise to purchase, I have not, as a fund manager, I haven't acted upon it. I haven't reacted to it by way of buying the stock from the market. Rather, that stock was with me right from the beginning. So this requirement of funding the promise is unnecessary, at least in this case. After this one, I would like to take an example, which is structuring of a covered put option, which uses the concept of VAR. Let us look into this covered put option. So there is party A, there is another party B, and for this structure to work, there should be another party C as well, although we can actually come up with a simple structure where only party A and party B are required. However, for the sake of explaining, I would be using this three-partite structure. So party A and party B are there. Party B now at T naught sells a stock X to party A on a deferred payment basis. So price of X, which is PX naught, is going to be paid at T1 on a future date, and the stock, which is the object of sale, this is delivered to party A. Now, so this is step number one. So once this has taken place, the party C comes in the picture. At T naught, after this first deferred payment sale between party A and party B has taken place, party B promises to purchase X from a party C, which is independent of parties A and B, at T1 on a future date for a price, we call it P opt. So this is promissory arrangement 1. At the same time, C promises to purchase X from A at T1 for P opt. So there are two promises in this case. A promise to purchase given by party B to party C, and a promise to purchase given by party C to party A. So in this case, in this simple example, we are using this P opt and this P opt, they are the same one. In practice, these prices would be slightly different from each other. And of course, they would be different from PX naught as well. But just to explain the concept, it's okay to use the prices in the two promises the same. Now, after this promissory arrangement has taken place, i.e., party B has sold a stock X on a murabaha basis, on a deferred payment basis, and B has given a promise to purchase to party C, and C has given a PTP to party A. What happens at T1? So this is at T naught, these promissory arrangements, everything has taken place. So at T naught, the party B sold the stock X to party A for this price PX naught. And this is the promised price to be relevant in future at T1. And this PXM naught, this is the actual market price of the stock at T naught. So basically there was this murabaha profit when the party sold the stock to party A for PX naught. At T1, the market price of the stock is PXM1, which happens to be less than the promised price, which is P opt. The promise to purchase given by party C to party A is therefore in money. So party A will therefore call upon the PTP given by party C to force it to buy X for P opt, which happens to be greater than the then prevailing market price of the stock. So basically, in this case, this PTP, promise to purchase given by party C, would be called upon by party A. Party A will therefore call upon the PTP given by party C to force it to buy X for P opt. At the same time, the PTP given by party B is in money. The other promise, this one, hence party C will call upon the PTP given by party B to force it to buy X for P opt. The end result of that would be what? So what are the payouts at T1? Party C, which was the third party, its net payoff would be 0 because it would be buying the stock X from party A for P opt, and then it would be selling the same stock X to party B for the same price P opt. Hence, its net payoff would be 0. Party A, it has actually paid the price of PX naught to party B, and it would be getting a price of the stock of P opt, which in this example happens to be greater than the PX naught. Hence, its net payoff would be positive. Let me take you back here. This is the PX naught. This is a P opt. P opt happens to be greater than PX naught. Hence, party A would be making some money out of this arrangement. Party B's payoff would be paying P opt to party C pursuant to the sale and purchase agreement which would happen after the promise has been called upon by party C, and it would be paying in PX naught to party A, and the net payoffs of party B would be actually PX naught minus P opt, which would be less. In conventional terms, this will be equivalent to the party B exercising a put option. So in this case, this whole arrangement would be deemed as a put option for party B, covered put option. Now, if conversely, at T1, the market price of the stock had gone up to this point, PXM1, in that case, the promise given by, or these two promises, actually, they will be out of money. So the promise to purchase given by party C is out of money. Hence, party A will not call upon that promise given by party C. And at the same time, the promise given by party B would be out of money as well. Hence, party C will not be calling upon this thing. So basically, nothing would happen pursuant to the promissory arrangement. So this optionality is now, I hope, understood. In first case, when the price was actually PXM1, the two promises would be called upon. When the price is PXM1, no promise would be called upon. Hence, in this case, the payoffs would be such that this would be equivalent to the party B not exercising a put option, but still having a positive payoff, which makes this covered Islamic covered put option different from a conventional covered put option, where if covered put option is not exercised, then party B would not be making money. In this case, we say party B still makes some profit, which is murabha component of the murabha price. That would be the payoff of party B. Now, this is an interesting case, and I would like to explain that one. Sharia compliant short selling. Many of you must have heard that short selling is not accepted in the context of Islamic finance, which is true in general. However, there is a possibility of coming up with a Sharia compliant short selling structure for those who would like to use this as part of their portfolio management or investment management, etc. I would not go into detail the fiqh discussion on whether short selling is acceptable or not. I must say that in general, short selling is not deemed acceptable in Islamic finance, but there are ways of coming up with some structures which would give rise to the economics of short selling. Although, as we see in this case, short selling is quite different from the conventional short selling. However, it fulfills certain economic needs. So we have party A and party B. Party A sells stock X to party B at T naught. And of course, this is on a deferred payment murabha basis. This price P mur is to be paid by party B at T1. When we say short selling is not accepted in an Islamic finance context, the major criticism of short selling is that, in case of conventional short selling, you sell something which you don't possess or you don't own. When we have this arrangement, actually party A is selling to party B, which would be effectively short seller in this context, a stock. So party B actually buys this stock X in order to receive the economics of short selling in a Sharia compliant way. So this objection, or you are selling something which you don't own, this is taken care of by this murabha based arrangement between parties A and B. Party C, as in the previous example, this is required as a facilitator of the transaction. So at T naught, after this arrangement has taken place, A promises to purchase X from C at T1 for price P1. This is promise number one. And promise number two, at the same time, C promises to purchase X from party B at T1 on a future date for a price P3. So remember, I said in certain cases, the prices would be different. So this P1 and P3 are slightly different. So this is promise number two. Promise number three is this one. At T naught, C promises to sell X to A at T1 for price P2. So the first promise given by A was promised to purchase X from party C at T1 for P1. The second one is this party C promises to sell X to A at T1 for P2. These are not equal and opposite promises because the prices in this case are different. This is an important consideration, that if the prices are different in otherwise two seemingly opposite and equal promises, they are actually not equal and opposite promises. Hence, these two promises together would not give rise to a bilateral promise, and hence these two promises would not be considered as a contract. So the fourth promise is B promises to sell X to B at T1 for price P4. So this P4 price is different from this price P3. And of course, P1, P2, P3, P4, all of these are different prices. So P1, P2, P3, and P4 may differ only by a few basis points and could be around P0, which is the initial price of the stock at the start of the period. So P1 in this example is greater than P3, and P2 is greater than P4 in this one. And of course, the party B, after it has bought this stock X from party A, it would be selling that stock X in the market. So it would not be the case of buying and selling something which you don't own. The party B has actually bought this stock X from party A, which is a broker, and has sold this in the market. In conventional short selling, this sale and purchase doesn't take place, but rather party B borrows stocks from party A and sells in the market, which raises a Sharia concern. In this case, party B actually buys the stock on which it wants to short sell and sell it in the market. The end result of this arrangement, okay, would be very similar to the economics of short selling. And hence we say that this is an arrangement which could be deemed as Sharia compliant short selling for those who would like to benefit from the short selling. I am in no way advocating short selling, but I'm just sharing with you a structure which could be used beneficially by those who would like to have exposure to certain financial products which are structured around short selling. There are some more exotic structures, swaps, for example. Using WAD, it is possible to offer risk return profiles of a very wide range of mainstream conventional products. And this is something which is already being used in the market. I'm not coming up with something new. Islamic banks and financial institutions, they are regularly using profit rate swaps, exchange rate swaps. Exchange rate swaps are used in a number of global sukuk offerings. So for example, if there is a sukuk being issued in Malaysia and this is ringgit denominated, however, international investors would like to invest in this ringgit denominated sukuk, then they would like to have access to a Sharia compliant exchange rate swap, which is structured around the concept of WAD as well. Such applications are exactly the same as used in this module, the first one, and of course this short selling example. They're very similar to these ones, although the pricing formulae in these swap structures may be a bit more complex. Given the usage or given the utility of the WAD, it is now possible to structure Islamic derivatives, futures contracts, and other such products. Although they are being used in Islamic finance, I must emphasize that their use is rather limited and they are being used for the benefit of Islamic financial institutions by Western investment banks, which offer these structures to allow Islamic banks to have access to risk management tools. They are not widely available, i.e. these Islamic derivatives, futures contracts, they are not available to the retail customers. Hence, there is no cause of concern for some conservative observers of the market that these structures may pollute Islamic banking and finance in a significant way. No, for the last 15, 20 years, when these structures were first developed, there is no proliferation of these structures in the wider Islamic banking and finance, and they are being used with restraint. In fact, IIFM, International Islamic Financial Market, has come up with standards and an overall framework to ensure that these structures are used as part of an Islamic risk management regime and not for speculative purposes, which is the case in conventional financial markets in most of the cases.